Do headlines like that make you nervous about the market? How do you separate the signals from the noise? Well, today we'll avoid the noisy headlines and examine three long-term signals that tend to appear months to years before a major turn. And then we'll also consider two short-term signals that tend to show up just before the markets roll over. None of these are magic and none are 100% reliable. The stock market is too complex and too dynamic to be captured in any one signal. But taken together, they paint an interesting picture of past market tops. And while every market is a little different, the endings for both phases seem to rhyme in some similar ways. Now, I repeat this idea a lot. I'm not trying to guess the exact top of a market. No, I want to understand what kind of market weather we have right now, which can help us consider what conditions might be developing on the horizon. At the end of this video, I'll also share something that really surprised me while I was pulling this material together. Okay, let's start with the biggest clue, the stock market's price tag itself. This chart shows the Shiller PE ratio. It describes how expensive the market looks compared to long-term earnings, sort of like the price tag on the stock market. These are the highest peaks before several of the major bear markets of the last century. 1929, the late 60s, 2000, and here we are in 2025, where valuations are the second highest in history. Does that imply a significant bear market coming soon? Maybe, but that's for someone else to figure out and predict. My primary concern is that this information tells us we have a clear signal of a coming market shift. A market PE above 30 warns months and even years ahead of the coming shift, not weeks. So when prices stretch too far from earnings, economics and financial math eventually pull them back down. Okay, so valuations are showing the stretch. Our next signal shows some strain. What's happening inside the bond market? The two-year yield reflects the Federal Reserve's pressure on the economy. Think of it like a brake pedal. Think of the 10-year yield as an investor confidence measure about the future. Generally, confidence about the long-term future should move the economy forward and overpower any short-term braking. But when the short-term rate rises above the long-term one, braking pressure is overpowering confidence, and that imbalance is a flashing yellow light, which has preceded almost every major market decline in recent history. In this chart, the blue line is the S&P index, and the green line is the 10-year Treasury rate divided by the 2-year rate. When the green line falls below 1, rates are inverted. Here's 1989, here's 2000, 2006, and 2023. I think this phenomenon has something like a 90% probability since the 1950s of being followed by a 20% market drop in the next 2 years. Right now, the curve is coming out of an inversion, though the market has continued up since 2023. We're at the 2-year point. Is this time going to be different? The market will let us know soon enough. So valuations show the stretch, yields are showing some strain. The next signal shows what investor fatigue can look like under the surface. Breadth measures how many stocks are rising versus falling. We've looked at a version of this chart several times this year, but in today's version, we can see the relationship between breadth and stocks together on one chart. The blue line again represents the S&P, and the green line here is the percent of stocks above their 200-day moving average price. When the percentage of stocks above their 200-day moving average price is high and then drops, even if the index climbs, then the rally's running on fumes and it may not have long to go. In 2020, the percentage started dropping months ahead of the March 2020 COVID crash. Interesting, huh? In late 2021, it started dropping before the 30% plus decline in 2022. Just this year, it happened again, months before the tariff decline started in March. And maybe it's happening today. We can't tell yet. This kind of drop doesn't mean the top is in, but it often comes just months before one happens, so it's worth watching. When fewer stocks carry the load, the index may look strong on the surface, but underneath, its foundation is softening. Those first three signals usually show up months or longer ahead of a turn. Now let's zoom in on what happens in the final innings, weeks or even days before the market turns. This chart shows the relationship between stocks and market volatility. The blue line again is the S&P. The green line is the S&P price divided by the volatility index, or the VIX. When the green line goes up, the S&P is rising faster than volatility. When the green line goes down, volatility is rising more than the S&P. I'm oversimplifying things here a bit, but that's the main idea for us today. When volatility rises faster than prices, institutional investors are buying protection in the options market. That's a sign of rising anxiety beneath the rising prices. Now, very often volatility starts increasing in the last stages of a bull market before it turns sideways or rolls over and heads down. Sometimes this ratio rolls over a few weeks to months before pullbacks, giving us a little warning. Sometimes, though, both roll over at the same time. This relationship gave some warning in late 2021. Again, earlier this year, the signal started flashing a warning in January, weeks prior to the tariff headline decline in March. We may be seeing it again now as breadth has fallen off since the summer, while the index has continued higher. When anxiety rises faster than rising prices, it's often a tell about an approaching shakeout. So if the rising volatility is an approaching storm cloud, our next sign shows hints that the big players are heading for the shelter. A distribution day happens when two things occur. First, higher than average volume, and second, the market closes down by at least 0.25%, though usually it's more. This is a clue that institutions are unloading inventory while prices still appear fine. Mark Boucher, an analyst and fund manager, taught this idea at a workshop some years back. It's been pretty interesting to see it in action. Here you can see the S&P price chart from late 2021. The pattern stacked up pretty quickly. 2 distribution days in late November, several more in mid-December, and then right out of the gate in January, 2 more. Then the market started declining right after this. So the rule of thumb about this is you need 6 to 9 of these days within a month, and that often marks the end of a rally. How do things look today? As of the close on October 22nd, we've had 4 distribution days in the last month, less than the warning threshold so far. When big money sells into strength, the crowd tends not to notice until the effects start becoming obvious. All right, let's put this all together, but first let me step back and provide a personal observation. I used to track market types and watch lots of indicators, trying to stay one step ahead of the market. But looking back now on that effort, I think I probably created more stress than clarity. Back then, without a systematic approach, I was trying to shore up my confidence about how to handle my investment positions. But I'm not sure all that work ever really helped that much. What surprised me this week about pulling this material together was how much less interested I am in these signals now. Yes, it's good to keep an eye on the market, understand general idea where we are in the cycle, but putting the same amount of time and effort into systemizing my investing instead, that seems like a much more fruitful investment itself. Now, I really let the smart signal system do the heavy lifting of figuring out how to respond to the market. It factors in what price shifts and indicators imply, not trying to predict tops or bottoms, but adjusting to the shifts month by month. By following a systematic approach, you stay prepared and maybe don't bother so much trying to predict the market. In case you're really wondering, is the market near a top? I will say yes, probably. How soon? I can't say when. More importantly, should you worry about a market top? not if you have a good plan or a good strategy and you follow it. Okay, our next video will show the damage that drawdowns can cause for compounded returns. In the meantime, stay calm, stay informed, stay on plan. See you next week. Oh, and none of this material is personalized investment advice. It is for educational purposes only. Here's my full disclaimer statement.